Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And today's question comes from Rod, who seems to have lost the options contracts that he originally sold. Hi Alan. Earlier this month I bought 200 shares of EDU at $22.62 and sold the $23 contracts at 65 cents. Over the next few weeks the price dropped and I rolled down to the $21 strike. Prior to expiration, the $21 strike prices seemed to have disappeared and replaced by odd strikes like $20.65 and $21.65. Your assistance prior to the end of these contracts will be greatly appreciated. Well, Rod, when you see the price of a contract changed, it's because of some kind of an event that changed the underlying value of the securities that you sold the options on. So we're going to review what some of these events might be, but first let's review the trade that you made, and then we'll move on to some of the possibilities of what might have caused these contract adjustments. Rod purchased 200 shares of EDU at $22.62 and then sold the 23 call for 65 cents, thereby generating an initial profit of 2.9% for the 1 month. Then Rod rolled down to the $21 strike, but it seemed to have disappeared prior to expiration. So let's take a look at some of the events that might lead to a contract adjustment, and there are several of them. Things like stock splits, which many of you are already familiar with, but other events like mergers, acquisitions, takeovers, and finally special one-time cash dividends, which is actually what did occur in this case. So what you do when you see the contract adjusted or something strange happen where you no longer see the strike that you sold, the best thing to do is to call your broker and ask for an explanation. Now, your broker may not have this information at his fingertips, but he will have the ability to look it up for you and explain to you what happened. Another way of doing it is to check cboe.com. Frequently you could find contract adjustment information on that site as well. And I actually have a screenshot for when I looked this up on the CBOE site explaining how these contracts were adjusted. So as you could see on the screenshot in front of you now, I've highlighted the $21 strike on the left column, which is the one that Rod sold the second time around, and how that was then adjusted down by 35 cents, which happened to be the amount of the special one-time cash dividend. So that strike from 21 was changed to 20.65. So what exactly is a one-time cash dividend, and why are the contract strike prices adjusted by that amount? Well, a special one-time cash dividend is a large dividend, usually much larger than your typical dividends that are distributed quarterly, and they're non-recurring. It's one time. And usually it takes place after extremely good earnings. So what the company will do, it will distribute these extra earnings to its shareholders in the form of this special one-time cash dividend. Now, sometimes these dividends will be distributed for other reasons, like financial restructuring, but mostly it's due to outstanding earnings. Now, what happens is, once you receive this dividend, the value or the amount of the price per share will decrease by that amount, because the actual price prior to the distribution was based on the corporate assets, which is now decreasing because of the distribution. So imagine the price of the stock dropping by 35 cents. Now, somebody who bought the $21 call option is going to be upset because the value dropped by the cash dividend. So to make the buyers and sellers of calls and puts whole, the strike prices are adjusted down by the amount of the distribution. So, Rod, in essence right now, you have now been the seller of the 20.65 strike, not the $21 strike, so you should handle your trades accordingly. So, in conclusion and in summary, whenever you see a strike price changed, some kind of a contract adjustment, the best thing to do is to call up your broker and ask for an explanation. You can also go to a website like cboe.com. Make sure you have a full understanding of what transpired so you know how to handle the contracts that you sold. So, Rod, I want to thank you for that very, very important question. It doesn't come up a lot, but it does come up from time to time, and we do need to know how to act when that does occur. And thanks to all of you out there for watching this video. Hope you found it useful. Hope you enjoyed it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.